Welcome to this presentation on bond investing. This is the first episode in the series on bond investing and valuation. So please like this video and subscribe the channel after watching if you enjoy the content. Now, bonds are debt instruments that allow investors to lend money to governments, corporations, or other entities in exchange for a fixed or variable rate of return. Investing in bonds could provide a steady stream of income and diversification benefits within a broad investment portfolio. The major factors affecting what are the areas we'll be covering in this presentation? The major factors affecting bonds valuation. What is the interest rate risk and how it affects the bond valuation? The bonds price yield relationship. What is bonds duration and how it measures the bonds price sensitivity to interest rate change? Mathematical derivation of bonds duration. What is bonds convexity and how it affects the price yield curve? Calculation of the bonds convexity. I am Aninda Datta, the presenter. The major factors affecting bonds valuation are stated below. The periodic coupon rate that is to be paid as interest over lifetime of the bonds. The present value of all future cash flows to be received from the bonds discounted at an appropriate prevailing market interest rate. The discount rate. The interest rate used to discount all future cash inflows from a bond to arrive at the present market price. The discount rate is dependent on the yield curve of bonds of similar risk profile. Duration. The sensitivity of the bond's market price to change in the market interest rate. Credit risk. The likelihood of the bond issuer defaulting on interest or principal payments. Liquidity risk. The difficulty level with which a bond could be sold in the market, generally measured by metrics like a bid-ask spread, traded volume, etc. Risks. The bonds with higher risks require higher discount rate. The associated risk may be market perceived or based on the assigned credit rating. Taxation. The manner in which the interest income and the capital gains are taxed under the income tax laws has a bearing on the bond valuation. The list is illustrative as other minor factors also affect the bond valuation. Now, what is interest rate risk? Interest rate risk is the probability of decline in value of an asset resulting from an unexpected fluctuations in the market interest rate. The interest rate risk is mainly associated with the fixed income assets. There is an inverse relationship between bond price and the market interest rate. Whenever the market interest rate rises, the investors could earn more interest by investing in new debt instruments. So the prices of existing debt instruments fall to make their coupon yield around the same as the existing market interest rate. In case of a fall in yield, the market price of existing bonds rise to ensure yield on existing bonds is similar to present interest rate. The change in market rate is not uniform across the term structure. All bond prices are affected by change in interest rate. The magnitude of change varies depending on coupon rate, time of interest payment, the payment of the bond, the term of the bond. The magnitude of change in bonds price is measured by duration and the convexity. Now, what is bond duration? All the fixed rate bonds are subject to interest rate risk. Duration measuring the rate of change of price with change in the market interest rate. Now, this is the calculation of duration on a spreadsheet. This is the each period year, which indicates the year 1, 2, 3. This is the cash flow in every year depending on this coupon rate. This is the present value of the coupon amount received. It is this cash flow discounted by this yield to maturity. So it's reducing as the year goes by. This is the weight. This divides C by the total, that is 75 by 678 becomes this 0.067. Then here 71 divided by 678 becomes 0.063. And this is the multiplication of period into weight, that is this period into weight. So when this add up all these and this 8th year, there is that principal repayment, so the amount is so high. When you add up all these four, this becomes 6.32. Now, why the periods are multiplied? Since if the bond interest, if the market interest increases, then the holder of this bond, suppose for the coupon payment of this 7th year, the holder of this bond would be receiving, would be discounting this 7th year payment for lower interest received every year. So this is the this is multiplied by 7. Now, the Macaulay duration tells the weighted average time that a bond needs to be held so that the present value of the cash flows is equal to the current market price paid for the bond. Now there is another modified duration which is arrived at by doing a small arithmetical adjustments to the Macaulay's duration. This modified duration measures the price sensitivity of a bond where there is a change in yield to maturity. The modified duration is calculated by doing a small arithmetic operation on the Macaulay duration. The yield to maturity is the expected annual rate of return earned on a bond, assuming the debt security is held till maturity. It is one interest rate that discounts all future cash inflows. Then those future cash inflows are added up to equal the market price. As duration is a result of multiplication of time period and weight, so if the payments are front loaded, the duration is low, whereas more payments are deferred, the higher is the duration. The duration of a bond in real life is not constant across different market interest rates. Now, the bond price prediction for change in interest rate using modified duration gives a linear bond yield relationship. That linear relationship is given by this green line. However, in real life, the price yield relationship is not linear as the duration is not constant across the interest rates. Here, a convex shape has been shown. This blue line is the convex curve that shows the real life relationship between the bond price and the interest rate. So this shows the bond yield and the bond price based on the duration. So that is the linear relationship. So the duration is the first order derivative of formula for bond price with respect to yield. So the slope of a tangent drawn to the price curve gives the duration at that interest rate. Now the convex shape means the duration keeps reducing with increasing in interest rate. Here tangents drawn to curve become more horizontal as we move towards higher interest rate. This black line is the tangent drawn to the curve, to the convex curve at this point of interest rate, and this second black line is another tangent drawn to the curve at this interest rate, this point. See, this tangent drawn at the higher interest rate is more horizontal, so clearly indicating that slope of the second tangent is lower than the slope of the first tangent. So the duration of the second case is lower. Here a single interest rate has been used to discount all the future cash inflows. But in real world, the yield curve is never a straight line and shows different spot rates for different time periods. Now, how to find duration from a mathematical formula? Now this Excel sheet shows the Macaulay duration calculation for a bond. Now this is the bond price formula where C represents the cash inflow for a specific year, and 1 plus dividing by 1 plus yield to maturity discounts that cash inflow to the present value. And this shows the summation of the present value of cash inflows for every year plus the it is added to the present value of the principal repayment received from the bond. As bond price is the present value of all future cash inflows, so the above formula gives the summation of the net present value of cash inflows of every year. The first order derivative of the price formula with respect to yield gives the dollar duration. Dividing the dollar duration by P gives the duration in percentage terms. The bond convexity measures the non-linear relationship of bond prices with changes in the interest rate and is defined as the second derivative of price formula with respect to interest rate. The result is divided by P. So this is the convex. So this is the convex diagram shows this is the showing the linearity of the bond price prediction by duration, but linear estimation overestimates the price decrease and underestimates the price increase, as shown in the diagram. The convexity estimation, increasing duration with increasing yield, is called positive convexity. As convexity is market determined, so accurately predicting the convexity of price yield curve of a bond mathematically is quite difficult. So convexity is calculated from price rate curve as per the given formula. Here the bond price is increased and decreased by a small amount for a delta y change in the market interest rate. So this gives the convexity approximation. Convexity is more helpful in predicting the change in bond price over a large change in market interest rate, as price change resulting from small change in rate could be predicted by duration only. In bond market, only the bond price is observable and yield to maturity is implied. That is one interest rate that discounts all future cash inflows. The sum of present value is equal to bond price. The duration formula is based on uniform yield to maturity across the terms of the bond. However, the change in market rate across the term structure is not uniform, and market discounts different term cash inflows at different rates flowing from the yield curve. So price prediction based on above duration is not accurate, and convexity comes into play. Now, what are the factors affecting bond convexity and the advantages of convexity? The longer period payments are not discounted at full interest rate hike. So the yield to maturity based on new market price of bond shows a lower increase than the increase in short-term interest rate. The market price movement of most bonds exhibits a positive convexity. That is, the fall in price on rate increase is less than the duration, whereas the increase in price on rate decrease is more than the duration. For bonds with same yield to maturity and term structure, one with the lower coupons have the greater convexity. So generally, zero coupon bonds have highest convexity. Thus, bond convexity works in favor of the investors. One big advantage of bond investing is if an investor locks in a yield, he could earn that yield regardless of the market price movements if he holds until maturity and the issuer does not default on interest and principal payments. So this concludes this presentation. We'll continue covering various aspects of bond investing in the subsequent episodes. Thanks for watching.